And I have some preconceived notions about this, but I want to get your take. With these large tracts of land that you're purchasing, obviously you're buying them from someone who probably had, every desire to add value to their land before they sold it to get the most out of it that they could. What is it that prevents someone like that from doing this kind of value add themselves? What are the barriers to executing your strategy that others, not to say nobody's doing it, but that so few others are doing?
Yeah, that's a great question. And just to be clear, we certainly have bought large properties, large individual properties like 4,000 acres or 6,000 acre individual properties. But we also just identify a region and then buy core properties and then just expand around that. So it's really about kind of creating those economies of scale within an area, even though they might be individual legal parcels or spread around just a little bit. The question is a great question. Like, why does, to some extent, Farmland LP exist, and how do we actually add value? And what we found. So we bought a 4,000 acre property, for example, that was owned for 50 years and tenanted property. And it had 2 tenants on that land, each farming 2,000 acres. But both tenant farmers farmed exactly the same rotation. So the whole property was farmed 2/3 alfalfa, 25% industrial corn, and about 5% tomatoes, but they were processing tomatoes turned into pizza sauce. The landowner didn't have really much incentive to invest in that property, and the tenants didn't have an incentive to invest in that property. We acquired the property. The landowner was basically aging out. One thing is, we identified that there's actually a chunk of land that was farming wheat on that land. So we asked the guys, well, why are you farming wheat if this is, good for other crops? I said, well, we don't have the pumping capacity to farm this 300 or 400 acres and the other crops as well. We were like, well, how much would expanding the pumps cost? Oh, about $25,000. So if we went ahead and paid the $25,000, you'd be able to farm all these extra acres and higher value crops. Yeah, absolutely. Great. Easy investment, right? And again, neither the landowner nor the tenant. 40% of farmland in the U.S. is leased. Yeah. So you run into that kind of situation. Even bigger opportunity and challenge was converting it to organic. Those tenant farmers, and there's lots of stories about tenants converting farmland to organic. It takes 3 years. And then as soon as it's organic, someone else will come in and offer more money for that land on a lease. And the tenant who did all the work gets booted on that. So our business model is around buying this leased land that's growing high quality land, but growing low value crops, and converting that over to organic, increasing significantly the number of crops in that rotation and growing higher value crops and giving more farmers opportunities to farm that land. And that's where we've shown the increase in rent rates from, if we're making $750 an acre, the farmers are making at least that amount of money per acre. We go from 2 tenant farmers, there's now on that 4,000 acre property, 7 farmers. Wow. Farming organizations on that land. Went from 3 crops to 12 crops on that land, including 600 acres of organic blueberries, which we're actually growing and managing, producing organic blueberries with Driscoll's. So that's where there's just a lot of opportunities to add value to those properties. And it really takes that scale and the ability to go through that 3-year organic conversion period and identify the crop rotations, and then do that working with multiple farmers so that they can each operate at scale for the crops that they want to grow and that they're great at growing.
And when you set out to acquire these properties, does it start with a market thesis as far as blueberries? We think organic blueberries have this potential, so we need to go find a place that's well suited for that? Or is it based on, I'm sure it's based on a number of factors, but kind of where does it start?
Yeah, great. So first it starts on identifying the ideal geographies that we're looking at. So there's a very first screen, we talk about sunshine, dirt, and water. So when you're buying farmland, real estate would be location, location, location. We're looking at sunshine, dirt, and water. Sunshine is great growing climates. Dirt is high quality soils that have the capability of growing high value crops. And then water is very important. It's both the physical access to water as well as legal ownership of that water, essentially buying those water rights. And we're doing this through a just foundationally 15 years ago when we started, actually for 35 years, I've understood climate change. My degree's in biochemistry. I took a class literally on atmospheric chemistry when I was 20 years old, and really just kind of understood that how climate change was working, how it had already been impacting for 30 years, and how it was going to continue to go. And when you really look at those models, you really understand that there's going to be certain parts of the world and the US that are going to be harmed by climate change, and some areas that are going to stay the same or benefit from the trends in temperature and moisture as well, water. And so that's a very first screen that we do in terms of our geographies. Then we're looking at sunshine, dirt, and water. And then once we identify properties and identify the areas, do an acquisition, then we're going field by field, 20 to 40 acres at a time on our 18,000 acres, and identifying what are the ideal crops to grow on this particular field. And if we identify, for example, blueberries on part of that 4,000 acres that I mentioned that used to be in alfalfa and corn, then we say, who are the best farmers for this? And then bring in those farmers at scale. In the case of blueberries, we had experience with blueberries, but not in that geography. Then we went out and established a partnership with Driscoll's. They validated our market thesis, and now it's a very successful program with them.
That is really cool. With your strategy to add value, it seems like it's very farmland focused, and it would make sense given, Farmland LP being the name of the company. But have you all started to kind of move downstream at all to capture more of the value of what you're producing, or is that part of the strategy in any way?
That's a really great question. And we see a lot of institutional investment firms coming in and really wanting to be vertically integrated. And so creating their own brands. We see it in the blueberry space too, just to stay on that example. We are Farmland LP. You're not going to see our label in the supermarket. If you're vertically integrated, that means that you grow your own product and you do all the sales, marketing, and distribution. Those businesses are very different. For blueberries, we have a great kind of 6 to 8 week window, and on each of our properties, we're producing great blueberries during that time. And the rest of the year, we're just nurturing the plants and taking care of the plants. If you're a sales, marketing, and distribution organization, you have to provide your customers, supermarkets, with year-round, high-quality production. Okay. The only way you do that is by being an entirely global sourcing organization and sourcing fruit from the Southern Hemisphere and the Northern Hemisphere and up and down the coasts as the markets mature. Those are completely, radically different business models. And so invariably, if you're focused on sales, marketing, and distribution, you're going to see greater opportunities you're going to need to increase your marketing spend or whatever you need to do. And you're going to look at all this farmland that you own that produces for you 8 weeks out of the year. And it's only generating low teens returns. And you're talking about 25% returns in sales, marketing, and distribution. Your CFO or your board members or your shareholders are going to come in and say, why are you holding on to these low teens returns assets when you should be investing all that capital in sales, marketing, and distribution? And so for the other institutional investors that I talk with who are vertically integrated, I say, when you grow up, we'll be here to buy and manage the farmland. And we'll be able to create a great relationship with you. We'll be able to expand your production. We'll grow incredibly high quality stuff and give you access to more land without you having to increase your balance sheet spend on it. And so that's why we know who we are. We love buying farmland. We love managing farmland. We do it with great economies of scale, and we'll let other people do the sales, marketing, and distribution. And it allows us to have really extraordinary partnerships with groups like Driscoll's, because they know we don't have another brand. We're not going to compete with them on this. And so it really gives whatever market sector it's in, it really validates for them that they have a great partner with us.
Oh, it makes so much sense. Yeah, with partners like Driscoll's, why would you want to go? I don't know anybody who would want to say, I'd really like to compete with Driscoll's on berries. It sounds like someone you'd rather have in your corner.
Driscoll's has a premium brand. They produce a premium quality product. Their mission is to delight their customers, and that translates to a price premium. Well, their markup, their sales margin on what we produce is basically our net after paying them for sales, marketing, and distribution is greater than what our sales price would be if I was trying to sell an off-brand. So it's just win-win-win for everybody.